We discussed all this under during Professor Pest's class. Then after that, Dr. Obege came in. He taught us financial intermediation. All right, he taught us financial intermediations, financial intermediaries. He just then theory of banks, financial market. And we're told the characteristics of financial markets and types of financial markets. Then, okay, Dr. Ogege gave us some assignment question, which we'll review tomorrow, right? So we shouldn't be surprised because the last one on 838, it was the assignment that he gave us as an exam question. That's the one on break-even point. So we will not underestimate his assignment again on 812. So I will just review my solution tomorrow for this 838 assignments. Right then, Dr. Obademi, who happens to be the last lecturer, too. So he also discussed the coexistence of financial intermediaries and financial markets. So he discussed this with us then, financial regulatory framework. So these are the aspects covered by Dr. Obademi. Then he gave us some random questions in class. So all these questions are what we are going to solve tomorrow by God's grace. Then lastly, Dr. Oyewale too came to the class. He taught us Nigerian financial system. He gave us some breakdown, balance sheet management, analysis of bank performance, liquidity, financial regulatory institution. Then he also gave us some questions too. So by God's grace, we'll try and cover all these questions tomorrow. So tomorrow is purely on the AOC given to us. So I will just summarize all the AOC, then we will discuss the AOC only tomorrow. So tonight is just for us to, try and have understandings of the topics itself. So that is what we are discussing tonight. So having said that, let's move on now. So we'll be starting with, we'll be starting with a fresh topic. Most of these topics are what we've done before. So however, I would like to start with the theory of bankings. First of all, this is the approach. I'm going to take theory of bankings to this evening. That's Dr. Obademi. I will discuss theory of banking. So after theory of banking, then we'll move on to the various types of financial intermediaries. Then we look at the characteristics of financial intermediaries. So that's the approach of what we are discussing tonight. Then when we are done with those aspects, then we can now go back again and review those theory of financial intermediations once again. So I would like to ask us a question. So I want a volunteer among us to kindly answer the question. So the question is, can someone tell us the meaning of financial intermediation and the meaning of financial intermediaries? Let me write. Define financial intermediation. Also define financial intermediaries. So can someone explain this too, or are they the same thing, sir? Let me start from here tonight. What is financial intermediaries and what is financial intermediation? Anybody can please attempt this. Anybody can attempt this, please. What is a financial intermediaries and what is financial intermediation? So let's start by understanding these two concepts tonight before I now delve down into the major. Okay, yeah, please start. Go ahead, sir.
Okay, financial intermediation is the process by which financial intermediaries channels fund from savers, channels funds from savers to borrower. It reduces transaction costs, manages risk, improves allocation of resources in the economy. It's just the means through which financial intermediaries channel funds from a surplus economic unit to a deficit economic unit. That is financial intermediation. While financial intermediaries, these are institutions like banks, insurance companies, pension funds, mutual funds that have as middlemen between savers and borrowers. That is the fundamental things I understand between the two.
Okay, so he said financial intermediation, it is a process through which financial intermediaries channel funds, right, or transfer from the surplus economy to what? To deficit economics, right? Okay, then financial intermediaries are the institution, okay, that act as the middlemen, correct, between the borrowers and the lenders. No, between the borrowers and the, is it lenders or savers and savers? Correct? So this is absolutely correct. So I'm going to delve more into this as we progress. So this is just to whet our appetite as we commence tonight's discussion. So I'm going to discuss this table as we proceed. So let's start with the first topic that we are discussing tonight. The first topic that I would like to discuss with us tonight, which we have not done before, and the Spirit said I should touch it tonight, is theory of banking. Theory of banking. That's what Spirit said I should start with tonight, and I don't joke with my spirit. You get why? So what is theory of, if everything I will be taking tonight they are from the Spirit. So what is the theory of banking? What is theory of banking is all about? So this theory, the theory of banking focuses on the behavior and operation of bank as a financial intermediaries. So it focuses on how the banks behave and how banks operate. That is exactly what the theory of banking is all about. So it's basically trying to understand the role of a bank as a financial intermediary. So there are various things that the theory of banking discuss. So first thing is that it's trying to explain the role of a bank as a financial intermediary, because whether you like it or not, bank is the largest financial intermediary ever in the world. The largest financial intermediaries is bank. I don't think there is anybody on this call that does not have a bank account. So bank is the largest of financial intermediaries we have in the world. So the theory of banking basically focuses more on the operation of a bank as a financial intermediary. So it discusses how bank operates, right? How bank operates as a financial intermediaries. How bank operates as a financial intermediaries. Then it also makes us to understand how bank take decision. How bank take decision, okay, or relate with customer. How bank takes decision. How bank relates with customers. How they relate with customer, government agency, and other financial institutions. So these are some of the things that this covers. Then it also makes us to understand, if you study theory of banking, these are what you are going to understand. Number one is that the theory of banking focuses on the behavior and operation of bank as a financial intermediaries, right? So it explains how bank operates as a financial intermediaries, how they operate. That is how they are able to gather money from the savers and lend the money out to borrowers. Then second one is that it explains how banks take decision, relate with customers, government agencies, and other financial institutions. Then it also explained that banks survive on interest income. It explained that banks survive on interest income. So what is your interest income? Let's say banks survive on net interest income. This net interest income is the same thing as the interest on loan that banks borrow out to bank gives out to people. Loans, whatever loans bank give out to people, less interest paid on depositor fund. Depositors fund mean the money that customer brings to the banks, right? they will pay customer interest, then they lend out. So the difference between the two is what banks survive on. That is where they pay salaries and everything from. So that is what is known as a interest income. So it explained to us that banks only survive on whatever money they earn as interest income. Then it also explained that banks sit on a lot of risk. So the example of risk that banks sit on is the credit risk. Credit risk simply means the risk that whoever the bank give out monies to will not pay back. That is credit risk. Then it's also explained that bank also sit on interest rate risk. Okay, they sit on interest rate risk and they also sit on liquidity risk. So these are the three major type of risk that banks sit on. Okay, so still on that theory of banking, it also tells us the various types of bank. That is, we have the commercial bank, we have the microfinance bank, we have the mortgage bank, we have the infrastructure bank, then we have the bank. Okay, I think that let me stop there. So these are some of the type of banks that we have. So under theory of banking, these are what you are expected to know under theory of banking. Let me recap it again. Or don't let me do the recap. Okay, let me recap, then I'll call one person to recap, then we'll move on to the next topic fast. So the theory of banking simply focuses on the behavior of a bank and how banks operate as a financial intermediary. You know, like I said, banks, they are the biggest financial intermediaries in the world. So when you study this theory of banking, some of the lessons that you're going to learn is that first, you will understand how banks operate as a financial intermediaries. You will also understand how banks take decisions, relate with customer, government agencies, and other financial institutions. Then you also understand that banks survive on interest income, which is the difference between whenever they give out loan to customer, they collect interest from them. And whenever customer also deposit money with them, they pay interest on deposit. It could be interest of fixed deposit or everything. So the difference between the interest on the loan they give out versus the interest on what they paid on deposit is what they depend on. That is the net interest income. All right. So banks survive on net interest income. Then it also explains the risk management in the banking industry, such as the credit risk, the risk that the banks will not be able to, customers that borrows money from bank won't be able to pay back. Then interest rate risk, that is a risk that there will be fluctuation in interest rates, which might go back to the bank. Then liquidity risk that bank will run out of cash to meet up with their short-term obligations. So these are the various types of risk. Then it also tells us about the various type of bank, such as the commercial banks, microfinance bank, mortgage banks, and infrastructural banks. So this is what the theory of banking is all about. Okay, so who want to volunteer to just summarize this for us in 1 or 2 minutes in your own way, just based on what you have understand from my teaching? And who can volunteer to summarize this for us, or I call name? In case theory of banking come out on Saturday, you won't say you don't know what to write about it. Any volunteer to summarize this concept for us, the theory of banking? Okay, I'm going to call somebody. Who should I call? His thing is doing many, money more. Who should I call? Spirit said I should call. Oh, Oyinda Ramon. Can you unmute and speak, Oyinda? Spirit directed me to you that I should call you. Oyinda, just run us through theory of banking in about 1 or 2 minutes. Then move on to the next topic.
Maybe your spirit is always calling me. All right. So
Oh, yeah.
theory of banking basically explains how the bank operate as a financial institution or a financial intermediary within the financial system, how they carry out their operation, how they make their profits, how they finance their activities, and how they make their decisions, and also how they how do they used to call that? How they direct the activities, like nominating the board of directors, and how they carry out decisions such as internal control decisions, how they service their customers and all that, and also how they pay out loan, and also how they mitigate their risks as regards giving out loan, and like that. That's all.
Okay, I love the fact that you are able to explain this in your own way. Okay, now let's move on to the next one. I want to take financial intermediaries now. So let's take financial intermediaries. Let's take financial intermediaries as a topic now. Financial intermediaries. Thank God that I don't have to bother myself about the definitions of financial intermediaries. So let's take financial. So the theory of banking is completed now. Next topic, financial intermediaries. So what is a financial intermediary? So these are the institutions that acts as a middleman. Okay, they are the institution that acts as the middleman between the borrowers and savers. You know, it is under indirect financing. Note that financial intermediaries are required only under indirect financing. Okay, they are not required. They are not required under direct financing. You only need financial intermediaries under indirect financing. So there are those institutions that act as a middleman between the borrowers and the lenders, right? They are the ones. So what are the types of financial intermediaries? So types of financial intermediaries. Types of financial intermediaries. So there are two types of financial intermediaries. There are two types of financial intermediaries. The first one is we have the bank financial intermediaries. Then the second one is the non-bank financial intermediaries. So what are the examples of bank financial intermediaries? We have the deposit money bank. So example of deposit money banks are your commercial bank, such as your GTB, Access, Zenith, etc. Then we also have microfinance bank. Another one is microfinance bank. Why is this thing not aligning? You smoke? Microfinance bank. So microfinance bank. So example of microfinance bank, your Lapo, the many, you can trace them. See, another one is the mortgage bank, e.g. FMBN, FMBN or something. Then another one is, please tell me, Lo, tell me, there are many. I've forgotten. Mortgage banks. Another one is infrastructure bank, e.g. BOI, Bank of Industry. Another one is development bank. So we have merchant bank, etc. There are many, etc. So these are what is known as a bank financial institutions, right? Then we also have non-bank financial institution, still under types of financial intermediary. Under the non-bank financial institution, we have the insurance company. You can name all of them. We have the pension company. All these are our PFAs. Then we have, which other one again? Investment company. Okay. Then which other one again? Investment company. Which other one again?
Finance house.
Help me.
Finance
You said
house.
what?
Finance house.
Finance or discount house. Okay, let's leave it here for now. So these are the various types of financial intermediaries. Okay, now the next one is, let's look at the characteristics. They can say explain, list and explain the characteristics of financial intermediaries. They can ask, list and explain the characteristics of financial intermediary. Number one is that they serve as a risk reduction. They help with risk reduction. What do I mean by risk reduction? Oh, shit, I've moved this thing. What do I mean by risk reduction? What it means is that there are some risks that you may not be able to mitigate through direct finance. However, through indirect finance, you can be able to mitigate those risks because more due diligence, because these people, the banks, they have more access to information to detect potential risk. Okay, so financial intermediaries have access to more information than direct finance, so they can easily detect and mitigate early risk. So this is for risk reduction. Then the second one is scale economics, scale economy. What do I mean by scale economy? So they have access to a large pool of funds. Banks have thousands or millions of depositors that are keeping money with them. So the kind of money that financial intermediaries can pull together, you can't get that kind of money under direct finance. Reason being that banks have access to a lot of money from different people. So they have access to large pool of funds from different customer to transact with. So that is for scale economies. They have access to large pool of fund which they have gathered from different customers to transact with. Another one is regulation. So what do you mean by regulations, right? What do you mean by regulation? Regulation means that they are highly regulated. Financial intermediaries are highly regulated when compared with direct finance. Definitely, bank alone, they have a lot of government agencies regulating them. We have CBN, we have SEC, we have NDIC. There are just too many of them regulating them. The next one is the asset storage. Okay, asset storage. So financial intermediaries have the capacity. They have the capacity for asset storage through large pool of customer base. So they have the capacity for this. Even their customer base alone is an asset. Then investment advice is another one. Investment advice. So they have the technical know-how to offer investment advice to various customers. So banks also, they can offer you investment advice. They are not just there to collect your money. Okay, so I want to give us a question that all of us should go and ponder on, likely AOC. So what are the list and explain the importance of financial intermediaries to the Nigeria economy? This is a question. So let's all of us go through this. In fact, all the AOC, I will shortlist them, I will collate them and send them to us so that when we are discussing tomorrow, you will have practice ahead. So I'm leaving out with this question on this financial intermediary so that I can move on to the next topic. So we've covered two topics now, financial intermediaries, and we've also covered theory of banking. So let me load the AOC. I mean, not the AOC, the course outline, so that we can check all these things, whether did I miss out. So you can see financial intermediaries, we've just covered it now. Types and characteristics of financial intermediaries, that's number 5, we've done it. Functions of financial intermediaries, that is one I gave to us now as an assignment, which we are going to discuss tomorrow. So we've discussed theory of banking. We've also discussed the financial intermediation. So let's move on to the number 1 part. So I'm going to cover number 1, 2, 3, and number 6 together. 1, 2, we know we have done 4 and 5, right? 4 and 5, we have done it. So I'm moving on to 1, 2, 3, then number 1, 2, 3, 6. I'll cover them together. 1, 2, 3, and 6. So let's discuss them together now. So what do we have under? So these questions, please practice it ahead, but I will discuss it tomorrow as well. So let me move it up to my AOC, so that in case you see this question and you didn't solve it, so that nobody beats me up on Saturday. I don't want anyone to beat me up. Let me add it to my AOC. Yeah, so number 4. Listen and explain the importance of financial intermediaries to the Nigeria economies. All right, so let's discuss these other areas that, or is there someone that want to quickly summarize financial intermediaries for us, or should I just carry on? It's clear to us. Anybody, is there someone that want to summarize this finance in your own way? It's just the same way Inda summarize theory of banking for us. So we want to try financial intermediaries. So I give somebody a chance to explain this. Let me call somebody. Oh, my spirit is doing many more. So let me call Praise. Can you unmute? Praise, can you unmute and quickly explain this financial intermediary for us? Praise. Based on what I've explained.
Sorry,
Oh yeah, Praise, you can speak. You're on mute now.
I said I'm sorry. I'm doing something else. I'm just listening to the lecture from my class. So
Okay. Okay. The person next to Praise is Jim. Jim, do you want to bail Praise out by quickly explaining this to us? Jim, do you want to bail him out by quickly explaining these financial intermediaries for us? Jim does not want to speak. Let me stay on this page still. Let me stay on this page because I know those people that are on this second page, they joined late. That's why I'm calling them so that I'll know if they catch up or not. Grace, do you want to help us? Grace, share the grace of the Lord with us. Can you unmute and quickly explain these financial intermediaries, please? Grace. Okay, Grace is not unmuting. Mr. Ifan, do you want to try? Otherwise, I'll move on to the other page. Mr. Ifan, do you want to explain these financial intermediaries for us, please, quickly? 1 or 2 minutes is okay. Oh, I don't know whether people just join and listening or they just don't want to mute. I'm happy to also carry on without taking anyone's feedback. Okay, so let's just carry on then.
I can explain. Let me explain.
Okay, Ima, thanks, bro. Go ahead.
Okay, so speaking of financial intermediaries, we've explained it as those institutions that act as middlemen, because the entire idea of financial intermediary um, is the reason for the way we have financial markets. So that being said, there are institutions that, of course, have middlemen that ensure that you know there is that transfer of fund, or that free flow of fund between the surplus unit of the economy to the deficit unit. And of course, the surplus unit, as we know it, is the perspective of the savers. So just like you and I save money in the bank, of course, those funds are used. The bank takes those funds and are able to locate those that actually need those funds for their own capital projects, and of course that yield a maximum benefit to the society. And I think one very important aspect of financial intermediary was, I think, mentioned by Dr. Gege, such that financial intermediaries ensure that those funds, when the savers need those funds, they get easy access to those funds. So savers do not necessarily know who and who is using their funds at that point in time. But when they need those funds, they can get easy access to those funds. And I think that just explains or goes a little bit into liquidity and how it is important for banks, CRR, and the rest of that. So, but speaking of types of financial intermediaries, we've talked about banking, financial intermediaries, and non-banking. Right. So definitely for banking, we understand that the deposits, money banks, uh, the microfinance, mortgage, and the rest of those banks, anything that carries bank, yeah, and perform or act as a bank, right? Then for non-banking financial intermediaries, of course, we know that they include insurance companies, asset management companies, you know, investment companies, and different other entities, as the case may be. Okay. In terms of characteristics of financial intermediaries, yes, what I'm talking about the key distinctions, key features of what makes financial intermediaries financial intermediaries. Of course, we talked about risk reduction, the fact that they are able, because they have access to information. I think it was in Dr. Gege's textbook where he talked about information asymmetry and basically explained that it is a situation where one party has more information than another party. So in that situation, the bank definitely um, has more information of the lender and the borrower. That instance. So, um, as such, because they have such information, they are able to reduce risk compared to direct finance. Of course, in direct finance, you may not have much information of who, because so that connection, you trying to look for who you want to give money to or who you want to borrow money, and that's being able to find each other is always a problem, which of course financial intermediaries come to solve, right? So that's they'll be able to mitigate such risk and be able to, account for such risk when they arrive. All right. Scale economics. Definitely they operate a large pool of funds and they have several customers. So there is always some form of economies of scale in that sense. Then regulation, of course, financial intermediaries are highly regulated. Right? For the banking aspect of it, yes, they are regulated by CBN. If they are quoted on the stock market, they are regulated by SEC. The fact that they are companies that are regulated, under under CAMA, CAC, and the rest of those legal and regulatory provisions. For non-banking, definitely they are regulated as well. Insurance companies regulated, ICOM, pension by PENCOM, and the rest of that. Then asset storage, yes, they have the capacity to store a large base of assets because of the large pool of customers. So someone like a Dangote would need the kind of loan that would join, millions and billions of customers' accounts together just for him to take one loan. So yes, the bank or the financial intermediary would be able to, afford that because they have that high and large amount of asset storage. And of course, in terms of asset
Okay.
storage, they still okay. Yeah,
Yeah,
just
great,
to not
great,
waste time.
great,
So
great. You've done more than enough job, actually. I love the way you are able to go deeper. Excellent. So, let's stop here for now on financial intermediaries. I want to move on to the theory of financial intermediation itself. So we'll be starting by discussing a financial system. So what is a financial system? Like I said, separate the two first, financial and system. When we talk about system simply means when you are connecting one or two or more things together, that's a system. Then financial now involve the financial aspect of it. So financial system is a combination of three things. You have the financial institutions. Who are the financial institutions? That's the banks, right? It could be a BFI or non-BFI. That's financial institution. Operators. Who are the operators? The customers. You that you went to banks to transact, you are the operator. Then the instrument is, what are the type of instrument that you want to do? Oh, you want to buy treasury bill, you want to save, you want to withdraw. That's your instrument. So financial system is an interrelation or connection of financial institution, operators, and instruments in an orderly, that's the objective, right? They connect these three things together. Those things that are in yellow, that's institution, operators, and instruments that are in yellow. So they connect those three together in an orderly or regulated manner to ensure that there is flow of funds, which give the system the most important characteristics and distinctness. So that's basically what financial system is all about. So it's the interconnectedness or integration of financial institution, operators, and instruments in an orderly, that's the key. It must be in an orderly or regulated manner to ensure that things are done in an orderly manner. So that's financial system. Then financial intermediations, we've defined it now that the process, financial intermediation involve using the word process. That's financial intermediation. So the process of transferring fund from the surplus to deficit through an entity that act as middlemen. Those entities that act as middlemen, they are the intermediaries. They are the intermediaries. They act as the middlemen of intermediaries between the surplus and what and the deficit. And what are those intermediaries? These are the middlemen. Examples are your commercial banks, security house, investment company, pension, mortgage. These are all middlemen. Okay, so if you are to look at financial market, first of all, separate the two words. Financial market. What is a market? Is a place where things can be buy or sell, right? So when we now combine them together, we say financial market is a market where financial instrument can be traded. When you use the word traded, that means it can either be bought or sold. That is what financial market is all about. Where financial instrument can be traded. Traded means is either you buy it or you sell it. So there are two types of financing under financial markets or system. We have direct financing and we have indirect financing. So when we talk about direct financing, under direct financing, you don't need intermediaries. Here you are doing it on your own. That is direct financing. Meaning I will approach you, collect money from you without us involving third party. Or I go to bank myself to buy shares. I go to bank to do treasury bill. I did not engage any investment advisor. I just went to the bank to do it myself. That is direct financing. So this is the process of lending and borrowing of fund without lending and borrowing of fund without what? The uses of financial intermediaries. The process of lending and borrowing of fund without the uses of what? Financial intermediary. This is what we know as what? Financial or direct finance. So examples of direct finance are you borrow loan from families and friends. That's a direct finance. Direct purchase of shares, purchase of treasury bills directly yourself. You did not go to any consultant or any advisor to help you do it. Everything was done yourself. Those are the examples of financial intermediaries. Okay. Now, okay, Emmanuel, you have a question. Please go ahead. You raise your hand,
Okay,
Emmanuel.
thank you. Yes, thank you. I wanted to ask, purchase of treasury bills, direct purchase of treasury bills, can that be considered under direct finance? Because I would naturally assume that treasury bill is government security, and banks are already an intermediary between the government and the people.
Do we buy
purchase
treasury bill from primary market or secondary market? If you buy
it
treasury
depends.
bill from primary market directly, then that is a direct finance. But if you buy treasury bill from secondary markets, that's an indirect finance.
All right.
I don't know whether you
Okay,
understand,
thank you.
right?
I
Primary
understand.
market is when you buy it directly from the source. That's the direct.
Yeah.
But when you now go through banks or someone else to help you buy it, that's indirect. There are some kind of money that you have that you don't need bank to buy treasury bill, you get it directly. So it depends on how much you have. Okay. So
Yes.
challenges of
Thank you.
what are the challenges now that we've known the meaning of direct finance? What are the challenges of direct finance? The first one is, e.g., myself and Ima, we are friends. I just borrow money from Ima directly. I did not go through any third party. Ima only know challenges are number one, cost of information. Iman only know maximum of what I told him about me. If I'm hiding something from him, he will not know. So that's one of the examples. So under direct finance, you don't have access to much information. So that information asymmetry is there. They don't beat Arsenal. Those that refuse to join class because of Arsenal match, they don't chop them. That's number one, information, cost of information. Number two, liquidity risk is also there. So there is a limit to how much you can access through a direct finance. Sorry, there is a limit to how much you can access through direct finance. So an individual don't have enough, e.g., just like you asking an individual to lend Dangote money for what? Dangote can even buy the person's village off if possible. So then the third one is price risk. There is always risk related to what is the pricing of the instrument. How do you guys want to price it among yourself? Monitoring and transaction costs will also be very high. E.g., Ima borrow me money. What's it to take Ima to monitor me? It will be high than banks that pull resources together. In fact, banks have like a department for compliance and monitoring of customers' loan. They just have like few people there, and those few people they will give them like plenty in account to be pursuing up and down. So if you check, the cost per account will drop as against you just having one person that you give out money to, and you have to chase all of them up and down. So it's quite, so direct finance, there is cost of information, which is high, liquidity risk is there, price risk is there, and there is high monitoring and transaction costs. So these are the challenges of direct finance. Then let's move on to indirect finance. So indirect finance is a process of lending and borrowing of funds through financial intermediaries. So indirect finance is when you decide to borrow through a third party. That's through financial intermediaries. That is what is known as indirect finance. I know they started joining now. The people that went to watch Arsenal match, nothing joined there. I've seen them. So that is indirect finance. You borrow money through a financial intermediaries. All right, what are the differences between direct and indirect finance? So what's the difference between direct and indirect finance? So let's try, so they can ask us to list 10 differences between direct finance and indirect finance. The first one is that direct finance does not require an intermediary, whereas under indirect finance, you need an intermediary. Under direct finance, you believe that you don't need an intermediary. Then under indirect finance, you surely need one. Then second one is that under direct finance, there is already an existing relationship between lender and the borrowers. While under indirect finance, there need not be any existing relationship between lender and borrower. E.g., if I approach a direct finance myself, before Ima can borrow me money, myself and Ima, we must have, at least we've known each other for over a year already now. He knows me, I know him. We have relationship together actually. But the same way I have relationship, I can walk to Zenith Bank tomorrow. I said I want to borrow money from Zenith. They will not say because they don't know me before, they will not borrow me. No, they will give me checklist of documents or something that I need to provide. And if I'm able to provide everything, they will give me the loan without any prior relationship between us. So under direct finance, there is usually an existing relationship between the two parties, but under indirect finance, there need not be any relationship. As long as you meet up with the terms and conditions, you will get that money. All right. Then the third one is that Direct finance does not involve any regulatory body. So under direct finance, you don't need any regulatory body at all. Nobody monitor two of you. But under indirect finance, we have lot of regulatory bodies that monitors. Banks are highly regulated by CBN and the likes to monitor what is going on. Okay, so that is for that. Then another one is easy access to fund under direct finance. Why access to finance may require a lot of bureaucracy under indirect. So it is easy for me to borrow money from Michael than for me to go and collect the money from bank. I can collect 1 million naira from Michael just tonight. All I have to do is to call him, oh bro, I need so things, and I'll tell him one or two things, and he can disburse immediately if he is convinced. But still, you can't try that with bank. Bank will follow some process before they disburse. So under indirect finance, there is some form of bureaucracy before disbursement, whereas direct finance is quite faster. As long as at least you are able to convince the person, you get your money almost immediately. Then number 5, there is a limit to what the borrower can get under direct finance, and there is no limit to fund under. So under direct finance now, I can only give you money that I have in my accounts, right? I can't do more than my power. But under indirect finance, banks have more leverage to give out loans, right? So that is different. Then another one is that there is limited information under direct finance. This is already known already. There is a limited information that is available, whereas under indirect finance, there are unlimited informations. Lot of information is available under indirect finance. Then number 7 is that under direct finance, debtor can be listed on credit bureau. Why such doesn't exist under direct finance? So under indirect finance, if I default payment of my loans or interest to bank can leave. Okay, just a minute. Just a minute, so I'm changing. All right. Hello. Can you guys hear me? Can you hear me very well, please? I'm back. Network, I had to switch because it was fluctuating.
Yes.
Hello. Okay.
Yes.
So let me rush down. Okay. So I think I've explained a lot about the difference between direct and indirect finance. So let's look at the perfect market system. So this perfect market system is also known as the neoclassical theory, and also known as what? Arrow-Debreu model. So under this perfect market system, their own is that they assume that all conditions are perfect. So they are the advocate for direct finance. So this perfect market systems is also lead to what is known as a direct finance. So that is perfect market system. It leads to what is known as what? Direct finance. So under perfect market system, the following are the characteristics or the assumptions of a perfect market system. Number one is that no individual can influence the market, which means that they assume that nobody can influence the market, that the market is controlled by the forces of demand and supply. Okay, they believe that the market is controlled by the forces of demand and supply. That is, there is no individual person that can influence the market. That's number one assumptions under this. Then the third one says that conditions for lending and borrowings are equal for all categories. So which means that if Dangote want to go and borrow money, the conditions that bank will give to Dangote is the same as if Kazim want to go and borrow money. They will give both of all the same conditions. That's another assumption. The number four assumptions under this perfect market system is that there are no information costs. They believe that no transaction costs, no solvency, everything is free. That is one of the assumptions under perfect market system. And there is no information asymmetry, which means that everybody have the same access to information. That is what this perfect market is talking about. And there is ex ante information. These are the information before transaction, and ex post mean information after transaction. So this thing is saying is that all these informations are available to everybody. Nobody have more information than the other. And lastly is that there is a free entry and exit. So these are the 6 conditions for a perfect market system, right? This perfect market system, like I said, is a neoclassical market system, and it is also known as what? Arrow-Debreu model. So there are 6 assumptions. No individual can influence the market. The market is controlled by the forces of demand and supply. Conditions for lending and borrowings are equal. There are no transaction costs or no information costs, and there is no information asymmetry. So all this, and lastly, there is free entry and exit. So please note all these characteristics of a perfect market system. It's very important. So this perfect market system gives rise to what is known as a direct finance. So because all these things that we have under perfect market system, we all know that they are not true, right? So they now give rise to what is known as indirect market system. That is imperfect market system. So this imperfect market system arises because of the challenges that we have with a perfect market system. So that is what the imperfect market system came to address. It came to challenge some of the assumptions or theories that we have under the perfect market system. So this indirect perfect market system or imperfect market system is a market system that involves the use of what? Intermediaries. Remember, under perfect market system, we say no intermediaries. We will do everything on our own. But whereas under this imperfect market system, we make hello, who is that? Is that for me? Hello, is that me? For me? Okay, so let me continue. So under imperfect market system, they make use of intermediaries, right? So intermediaries. So now these guys now, to challenge all the theories that we have under the perfect market system, they now came up with some theories. Those theories they came up with were just to challenge those things that we have under perfect market system. So this now takes us to the theories of intermediation. So the first theory is this, that information asymmetry theory. So what this information asymmetry theory is talking about is that under the direct finance, the volume of information that you have under direct finance is limited when compared to indirect finance, which means that under the indirect finance, or when you make use of intermediaries, you have access to lots of information that you can ever have access to under direct finance. So this now break it down into 2 types of information, that is ex ante information. Ex ante information, they are those informations before a transactions occur. So those information before a transaction occur is known as what? Ex ante information. So if you don't have enough ex ante information, you now want to give out a loan that results into a bad debt, then that is now known as a problem of what? Adverse selection. So the problem of adverse selection occur when you give out a loan to somebody because you don't have enough information about that person. When you give out a loan to someone that you don't have enough information about, that leads to a problem called adverse selection problem. So this adverse selection problem is a problem that arises due to lack of adequate information before a transaction occur. Okay, then when you give out a loan to somebody, that loan now turn bad. So that is known as a moral hazard. So moral hazard is when somebody is unable to pay, because export information mean information after the transactions, right? So if somebody now default in this, is known as moral hazard. Moral hazard is when the borrower is unable to repay the loan as per the agreed terms and conditions. That's moral hazard. You're unable to pay. So how can a bank now reduce this risk of adverse selection and moral hazard? The first one is there should be a proper screening and KYC of the customer. You have to do your due diligence about the customer first of all. Then you should obtain intelligent report about the customer from credit rating. That is why some company will go and spend money on credit rating to get information about you, to know what is your history like. Are you the one that don't pay loan when you collect, or are you the one that is consistent with payment? They will get all those information. They will conduct a proper background check. They will review your detailed account. They will review risk diversification. So all these things I've said now, they are how bank can reduce adverse selection. Adverse selection is before the transaction. Okay. Now, what about how can they reduce the moral hazard? Moral hazard is after the transaction. That is a ex post. Number one is that there should be a proper monitoring. You have to visit the person from time to time to know how the person is coping. Proper loan agreement and insurance. These are the way you can deal with a moral hazard. So that is all about the first theory. Now, the second theory is a theory of asset transformation. So this theory of asset transformation can be grouped into four. We have the risk, we have the liquidity, we have the maturity, and we have the, which other one again? There are four. Size. So what is the size? Size simply means that the volume of loan or facility that you want from bank. It is possible that a bank may not be able to afford you. There is something called obligor limit, right? Obligor limit simply means the maximum a company can access as facilities at a point in time. So if you have reached your obligor limit, there is no way you can access further facility again. You have to look for a way to free up your obligor limit so you can access for more facilities. So size simply means that should in case a bank receive a request that is higher than what they can give, then they can merge. 2 or 3 banks can come together and provide facility to a single lender. So that is the size. So size means this is when a single lender may not be able to provide the full amount of the facility. Therefore, the borrower needs to approach 2 or more lenders. The maturity simply means that sometimes you want to collect a long-term loan, whereas banks said they can only do a short-term loan. So there is that conflict of maturity because you want long-term, they said they can only give short-term. Then the third one is liquidity. So liquidity simply means that bank will collect your money from you. The money they are collecting money from you is shown as their own liability. So this their own liability, they will now transform it into assets. How? Whatever money they have collected money from you, they will now give it out to people. Meaning they are known to transform a liability to asset. That's what they do under liquidity, meaning moving that money from a liquid form to a liquid form. So that is what liquidity is all about. Then risk simply means they share risk, right, between 2 or more borrowers, between lenders and borrowers. And the last one is the transaction cost reduction. So because banks have large number of customers, so they enjoy economies of scales in terms of transaction reductions, the cost reduction. E.g., the cost it will take one person to pursue a debtor will be the same as salary that bank will pay to one lawyer that will be pursuing 100 customers. The same salary they will pay. So in that case, there is going to be overall reduction in your transaction cost. So I have some ex ante cost and ex post cost. So how can bank now reduce this transaction cost? That's another thing we need to look. How can they reduce transaction cost? Number one is the economies of scale. They do bulk. Like now, banks, they don't print their withdrawal slip or teller anywhere. They have a particular place they print in bulk. They will now share it across the bank. That's economies of scales. Digitalization is too. Banks, they've started using digital for everything. Even if you enter the banking now, they won't give you deposit slip. You have to go and fill a register, and from there they will pay you as against you filling the deposit slip. So many things is ongoing. Then the third one is in delegated monitoring. Delegated monitoring. So when I saved my money into the bank, it is the job of the bank to trade with my money and pay me back my interest. When I save money in the banks, it is the job of the banks to trade with my money and pay me interest. So if bank trade with my money, they now give out a loan to Mr. C. It is not my job as a depositor to go and be chasing Mr. C. It is the banks that gives out the money that have the power or duty to go and chase Mr. C. So in that case, I have delegated me monitoring that Mr. C directly to the intermediaries. So that is the meaning of delegated monitoring. Then theory of economies of scale. Under the economic of scale simply means that they have large number of customer base and transaction. Because of that, the overall cost of transaction will drop. Okay, so liquidity insurance theory. So this one simply means whenever there is a shock in the economy, such as the impact of the COVID-19 and the likes. So because of that, banks were able to fall back on CRR and all other deposits that they have. So the purpose of this liquidity insurance simply means that banks should keep some form of money somewhere in case of a rainy days. So in case there is a meltdown in economy, global meltdown, impact of shocks, they will have something to fall back on. Okay, so I think that is all about the theories of financial intermediaries. So let me list out those theories again. The first one is the theory information asymmetry, right? The first one is information asymmetry. The second one is asset transformation. The third one is a transaction cost reduction. The fourth one is delegated monitoring, and we have theory of information economies of scales, and lastly, liquidity insurance theory. So is there someone that can quickly revise this for us before I move on to the next topic? So we are done. I'm done with this theory. I want to move on to the next one. Is there someone, or Ima, do you want to just quickly do this summary for us, please, so I can just take a glass of water? Ima, do you mind summarizing this for us fast?
Oh, okay.
Oh, yeah, Ima, carry on. Yeah, thank you.
Okay,
The
are you
first one
sharing
is
your screen?
information asymmetry. Yeah, fast.
Okay. Okay. So in terms of theories of financial intermediation, I'm getting a feedback. Okay. Please, can you hear me?
Ima, yes, carry on.
All right. Okay, so in terms of financial information asymmetry theory, which is of course one of the theories of financial intermediation, we've explained information asymmetry theory to be a theory that explains that one party in a financial transaction does not have much information about the other party. So as Kazim mentioned, you want to give loan to someone, definitely you don't have all of that information. If you tell the person, go and bring your birth certificate, go and bring this one, go and bring that one, they will say your own is too much. So you cannot know all the information about the person for you to give the person the loan. But if there is a financial intermediary, definitely financial intermediary would try as much as possible to get all the information about that person, both from the customer as well as from the lender. So that is the theory of information asymmetry. And of course, we've talked about the two types of information, the ex ante information and the ex post information. For the ex ante, we've said it's before the transaction, while the ex post is after the transaction. And we've said that for ex ante, at the point where you give the loan, you don't have that information ex ante. There is a risk of adverse selection. Of course, for ex post, there is a risk of moral All right. So quickly, theory of asset transformation. We've already explained the theory to be as a result of differences in the preferences of lenders and borrowers, and we've coined out four major areas or four categories under the asset transformation theory, um, which is MRLS. That is maturity, risk, liquidity, and size. For transaction cost theory, okay, so for transaction cost theory, we explained that the theory relates to financial intermediary where they bear the transaction cost. So in a situation where you're in direct finance, all right, there is no transaction cost. That is basically how it was explained in the Arrow Bloom model. And in reality as well, you don't necessarily incur any cost where you want to just give somebody a personal loan, a family loan, a friend loan. And that's just it. But transaction costs in this case, of course, there is existence of transaction costs and it is incurred by the financial intermediary. And of course, transaction cost also can be ex post, can be ex ante as well. For ex ante cost, search cost, CAC related cost, verification cost, audit cost, KYC cost, and the rest of that. While for ex post cost, we talk about monitoring cost, legal cost, insurance cost, and prosecution cost, as the case may be. I don't know if that is all or if there is any other theory. I have some theories here. I'm not sure all of them were taken.
Okay, move on to the
Yeah.
next one. That's it. Okay, you've discussed asset transformation, right?
Yes, I have. I've discussed
Okay, delegated.
transaction cost as well.
Okay, you've talked about delegated monitoring, right?
No, I've not. Okay, so delegated monitoring. So
Okay,
delegated
discuss
monitoring theory.
this then.
Okay, I'll just end there. So delegated monitoring theory holds that financial intermediary must ensure that the borrowed funds are not mismanaged through constant monitoring of the operations of the borrower. Now, if you take, for instance, in direct finance, if you look at it from a perspective of direct finance, there is not much of monitoring that you can do. If you give a family or a friend loan, you can't go about to be bickering the person and be asking the person, how are you using the money? What are you using the money for? They will say your own is too much, right? But in a situation where you have a financial intermediary shoulders all those responsibilities. The banking financial institution or the non-banking financial intermediary shoulders the responsibility of that monitoring. So from the word delegated, you delegate the monitoring that you do not have to do, and the financial intermediary does all of those monitoring activities to ensure that the operation of the borrower aligns with what he or she wanted to use the loan for. So I think I would just end there. Thank
Okay,
you, Kevin.
thank you. So I think you've talked about the loans and everything. So the next one, okay, financial, let's move on now. So that is all about Dr. Opes parts. So let's go back to the syllabus. You know, tonight, what we are doing tonight basically is everything we have been taught, we are discussing it. So now we have done, this is the course outline. We are done with number 1, 2. We are done with number 3. We've also done number 4. We've done number 5. So I want to move on to number 6 now. Okay, let's move on to number 6. Yes. So let's continue. All right, number 6 is financial system. We've already defined system as the interconnected or interrelation between financial institution, operators, and instruments in an orderly regulated manner. So there are some elements of financial system. So as given by Dr. Okay. Dr. Oyewale. Number 1 is a financial regulatory framework. Number 2 is a financial market system. Number 3 is financial market. Number 4 is the financial instrument. Number 5 is other financial participants. And number 6 is when you combine all of them. So let's look at the first one, financial regulatory framework. So here we have the regulatory framework and the laws. So under the regulatory framework, the highest is the president and NAS, followed by the Minister of Finance. Then under Ministry of Finance, we now have a lot of agencies such as CBN, NDIC, NSEC, PENCOM, and they're all under Ministry of Finance. Although CBN governor report directly to the president, but still CBN, still the Ministry of Finance still have some oversight functions on CBN. Okay, then we have the financial law. What are the law? These are the law. The CBN Act of 1958, or they started operation in 1959. We have NDIC, NSEC, PENCOM, and NICOM. These are the law. So then the next one is a financial institution. This is grouped into two. We have the BFI, that's bank financial institutions, which are the deposit money bank, merchant, microfinance, infrastructure, etc. Then we have the non-bank financial institutions, such as your insurance, investment, pension, and finance house. Then the third one is a financial market. What is a financial market? Anything market knows where something can be bought and sold. So it's a market where financial instrument can be traded. And the word traded simply means where financial instrument can be bought and sold. So that's the summary of that. So financial market is grouped into two. We have the money market and capital market. Money market is for short-term instrument, while capital market is for a long-time instrument. Money market is where short-term can be bought and sold. Capital market is where long-term can be bought and sold. Then we have the financial instrument. So what is a financial instrument itself? So it's a contract. You know, anything financial instrument is a contract that gives rise to a financial asset of one entity and a financial liability or equity instrument to another entity. So we have the money market instrument and capital market instrument. Under the money market instrument, that's a short-term facility such as a treasury bill, commercial paper, and treasury certificate. While capital market are for long-term instruments such as the ordinary share, bond, debenture, preference share, certificate. These are the long-term capital market instrument. Then who are the other financial participants? They are your stockbrokers, forex trader, banks, depositor, informal sector such as your Ajo, Esusu. Then how do you now link all the 1 and 5 together? So this is basically through CBN regulation. E.g., if CBN make any pronouncement that transaction cost is 0, it will affect everybody because most of them depend more on the transaction cost. They depend more on the transaction cost. So that's all about that Nigerian financial system taught us by Dr. Oyewale. So let's take more tonight. Let's take more. This is 10:26. Let's take more. So let me see if I can take like 2 more topics. How many do we even have left? So
yes,
we have done 1 to 6. We've done number 7 to that's financial intermediaries and financial market. We've done that. Number 8,
yes.
macroeconomic consequence of financial imperfection. Not yet. We've done number 9, right? So let's discuss this bank performance measurement is the same one that we did under. Hello, is that for me?
Yes,
bank
I'm not
perf-
seeing you. I'm
Okay,
not
you
seeing
can
your
see it. Is there any other person that can't view my screen, please? Or is just the only one? Oh, I am not sharing actually.
I can't see your screen.
Okay,
See
what
your
about now?
screen.
Can you see it now?
Yes.
It
Yes.
stopped
Yes, we
sharing
can see your
actually.
screen.
It's coming, I'm sorry. Yeah,
okay.
it stopped sharing. I don't know why it stopped sharing. Sorry. So if you check your syllabus, we have done 1 to 6, 7. We have done up to 7. We've also done number 8. We've done number 10. That number 10 is what we've just finished now. Those regulation, whatever. Then let's take number 11, balance sheet management. Please note for your information that analyzing bank performance and risk management, they are the same thing as what we were taught under 815. So those risk management metrics that we read under 815, and bank performance, whatever, those things that we use in measuring bank performance, okay, they are still the same. Yeah, so 12 and 13, they are the same with 815, please. They are the same with 815, the same thing that we've done under 815. So let me take balance sheet management, then probably after balance sheet management, I can discuss liquidity, and we end it here tonight. So balance sheet management, basically we are discussing liquidity. So we use balance sheet management, from there we enter liquidity, and we'll call it a day. So I believe we've done a very good summary tonight of everything actually. Okay, so let's discuss balance sheet management. What is balance sheet, right? To any bank, their balance sheet test their strengths, and note that banks prepare their balance sheet in order of liquidity. They prepare their balance sheet in order of liquidity. That is how banks prepare balance sheet. It is done in order of liquidity. Okay, so what is now the balance sheet management? So this is the process of ensuring that balance sheets are managed effectively. So it refers to the effective ways in which the banks manage their assets, liability, and equity to ensure maximum profitability and liquidity at all times. That's balance sheet management. So when you're trying to check the process in which banks manage their assets, liability, and equity to ensure maximum profitability and liquidity. So that is what balance sheet management is all about. So in banking, balance sheet management refers to the strategic oversight of asset and liability and equity to ensure stability, profitability, and regulatory compliance. You can see the way you manage balance sheet in banks, your objective are three objectives. Number one is to achieve financial stability. Number two is profitability and regulatory compliance. So this is what you intend to gain if you manage the balance sheet of a bank very well. So the key aspects of balance sheet management, there are about 6 of them. But please note, 5, sorry. Please note that in class, they talked about just 2, liquidity management and profitability optimization. So we're not the remaining, they didn't talk about the remaining. So I'm not going to do over syllabus. So let's focus on the 2 that the class focus on. One is liquidity management and the other one is the profitability. So the last class, I think it was last week, I lay more emphasis on liquidity management and profitability management, in the sense that if you are very, very aggressive in managing your liquidity, your profitability will drop. And if you are very aggressive on profitability, then your liquidity will also get worsened. So the relationship between liquidity management and profitability management is inverse. So there is an inverse relationship between liquidity management and profitability management. So what are the controls that banks must abide by in ensuring that their liquidity is well managed? Number one, every bank must do what is known as OMO, open market information. That is the process of buying and selling of government security. That's number one way bank can maintain and sustain their liquidity. Then number 2 way that the bank can sustain and maintain liquidity is through CRR. This is like a compulsory saving with CBN, right? Then we have the LRR, liquidity reserve ratio, and we have the stability security. So those are the various ways that a bank can sustain their liquidity. So what are the examples of liquidity in the banks? How do banks get money? That's the next thing now. How do they get money in the banks? How do they have their liquidity in the banks? So the first one is through the cash held by CBN, through cash held with other banks within Nigeria, through Nigerian Treasury Bill, Nigerian Treasury Certificate, CBN. So these are the various ways that banks make money. So if they don't make money from any of this way, then they won't be able to give out loan or whatever to people. So profitability, so I've explained is that you can measure profitability in 3 ways. Number one is the return on total asset. Number 2 is the return on shareholders' equity. Number 3 is return on capital employed. Let me also add one more, net interest margin method. So this is another one. You can use net interest margin method. That's for profitability. So once you calculate all this ratio, you are good with profitability. Then the next one is liquidity. So for the liquidity now, there are two schools of fund for liquidity. The first school of thought is offer pool of fund approach, while the second school of thought is asset allocation approach. So those are the two schools of thought that we have under liquidity. So under the first one, which is pool of fund approach, here all your money, the money will be gathered together in one single pot. That's this pool of fund. Then you can now invest it on anything. So you can use short-time money to go and invest on long-term money. What you're after basically is the maximum profitability. So that's what pool of fund approach is talking about. Then the next one is, what are the problem with this pool of fund approach? We have the maturity mismatch, meaning that you will likely be using the short-time deposits to invest in long time. So if the person only the money call, voila, will happen. Then the second one is liquidity crisis. There might be liquidity crisis as a result of the mismanagement of your investment. Then if liquidity crisis will lead to CBN sanction and sanction from NDIC, finally you will quickly die, which is financial distress. Then the second one, I'm rushing because I want to finish up this. Then I will drop the video on YouTube. You can go through the video all over again. That's why I'm a little bit rushing. Then the next one is the AAA. That is asset allocation approach. So under the asset allocation approach, a fund can only be used for designated means, e.g., your demand deposit can only be used for your primary, secondary, and other securities. That's why you can order short-term security, not long-term. That's what you can use your demand deposit to do. Therefore, savings deposit too. You can use savings deposit for primary, secondary, loan and advances, and other securities. So and so on. I even put the formula here that shows you what you can use each one and which one for. So that is what we have under liquidity. So this last topic, let me touch it before we go tonight. Remember, one of the AOC is that Dr. Iwale says he will give us about 7 or 8 of this, out of which we are to explain 4. And before you are explaining, you will define, state the year it was established, you will state the objective for purpose and limit, just the way I have written it here. This is exactly how you are going to write it in your exam. Dr. Liwaye will ask us to explain, to give these details about 4 regulatory agencies, 4 regulatory and supervisory institutions. So you will define year of establishment, objective, and limitations. That is all you have to do for each of them. Emmanuel, over to you.
Casey, sorry to draw you back. That the liquidity bit that you were explaining earlier, the POFA and the AAA approach. So I wanted to ask, under exam condition, to explain them, can we draw the diagram?
If God give you the wisdom to draw it, fine. But me, I will run away. That's too big for me to cram all those things. If God give you wisdom to draw it, why not? Let's go ahead.
To know what to cram and what not to cram. Because
I'm not teaching you to cram. Me, I don't want to cram anything. That's why I am on that. Anything that will involve me cramming, I will not even bother at all. It's not answer 8 questions, it's answer 4. So I will surely see my own 4 to answer. Regardless of it, I will see my own 4 to answer. So,
all right.
Let's look at this. Or should I just leave this one to tomorrow when we are discussing AOC? Because I don't want to rush this. So, yeah, like we did last week for Greek, those YEP, Youth Empowerment Program, Anchor Borrowers. I want us to do the same exercise tomorrow for all this. There are about, how many of them? I have about 10 of them here. So these 10 of them, we all need to master at least 4 each. So let's leave this to tomorrow when we are discussing the AOC. So I will run through this and you will all choose any of the 4 that you want. I believe the method we chose last week, YEP 2001, CI Cassava Initiative Program 2002. I believe that method works. So we'll follow the same method for that. At least we know that out of 4 questions, we have gotten 1 already. Okay. So let me start.
Please, we need to add way forward.
Way forward. Okay, way forward is here. I think I wrote way forward. Let me show you number 1. limitation problems. Is there a way forward? I thought this is what he wrote for us now. Is there definition, year of establishment, objective? Is there a way forward there? Tell me.
Yes, please. Yes.
Okay, I will note it.
So there's no.
So, okay, tell me. Let me stop recording. Please tell me. You can continue commenting, please.
I don't think there's way forward here. It was in that the other scheme where we have
it was under the agreed.
advantage. Yeah.